The last thing we need to consider about a classified balance sheet is where it fits in with all the accounting theory. So to do that, let's take this example here. Which business would you prefer to own? We've got business A here and business B here. So we'll start with this. Both businesses have assets of 100,000. So there's business A's assets, there's business B's. I can't split them at this point. I need some more information. So let's look at the liabilities. Well, both businesses have liabilities of 70,000, and I can't split them either. They look identical to me on paper. And what we've got here is actually a balance sheet that hasn't been classified. That's what a regular balance sheet gives us. It just gives us total assets and total liabilities. So what we do is we classify things so we can learn more about the business and also distinguish it from other businesses. So let's take the assets. So we'll say this $100,000 of assets for business A is made up of 50,000 current and 50,000 non-current, and for business B it's made up of 20,000 current and 80,000 non-current. Well, now I can start to look at this and go, I'd actually rather be business A at this point, and that is because it's got $50,000 of current assets. That means $50,000 of assets that are either cash now or will become cash within 12 months, whereas business B only has $20,000 of those. So this has got twice as many, business A, twice as many current assets as business B. So I'd rather be them. However, a classified balance sheet also allows us to look at the current and non-current liabilities. So now we start to see a different story. We can see here for business A, its current assets are 50,000, but its current liabilities are 60,000. Whereas business B, look, it's only got $20,000 of current assets, but it's only got $10,000 of current liabilities. I'd actually prefer to be business B. And the reason is this. It's going to be able to meet its short-term debts, so debts within the next 12 months, it's got double what it needs. So we've got $10,000 of current liabilities and double that in assets. Even though $20,000 on its own isn't high, it is double what is expected to be paid within the next 12 months. Whereas business A, even though it's got $50,000 of current assets, it's got more than that in current liabilities. As it stands right now, in the next 12 months, this business doesn't have enough money to cover its current liabilities. And that's the beauty of a classified balance sheet. It gives us more information so we can make better decisions and understand things. So we're going to stop doing just a regular balance sheet here with everything under one group called assets and liabilities, okay? Because it doesn't answer questions like this. Which liabilities must be repaid first? Which assets will become cash soon? Will some assets be owned for many years? And has the business got enough money to pay its liabilities this month, this year, in 10 years, etc.? So that's no good. So we're going to classify things like this. And we use the two columns. We put the item under current assets in the first column, then the total in the second column. Non-current assets, item, total, and then we total them all up. Same with liabilities. We put the items in the first column for current liabilities, total in the second. Same for non-current liabilities, total in the second, and then we get our owner's equity there. And the beauty is I can now answer these questions. Which liabilities must be repaid first? Which assets will become cash soon? Will some assets be owned for many years? And has the business got enough money to pay its liabilities? I can answer all those questions now by looking at that. Okay, I can see what is cash or expected to be cash in the next 12 months. It's 35,000. That is more than enough to cover what is due within the next 12 months. That's $20,000. What assets do I expect to have for many years? I expect to have the property and the vehicles. However, I can look at this classified balance sheet and go, well, I better plan for this in 10 years' time. I've got a mortgage here that's just going to sit here until 2035 of 50,000, so I need to factor that in. So that's the beauty of a classified balance sheet. So in terms of the theory, well, let's just take a look at some of the theories that we learned. We learned assumption number 2 was going concern. The financial reports of the business are prepared on the assumption that the business will continue to exist and operate into the future. It won't be wound up, and it will continue its activities as a going concern forever. And the reason why we did that is so we can break our assets into current and non-current, and so we can break our liabilities into current and non-current. So that's what that theory said. So we just got to relate it now to a classified balance sheet. We'll come back to that. Let's look at this theory. This theory, qualitative characteristic number 1, was relevance. It said accounting must be relevant. It must be capable of making a difference to the decisions made by users by helping them make informed decisions. So we better come back to that. How does a classified balance sheet help us do that? Well, let's look at this. We can now make decisions like with this information. So here's a nice classified balance sheet again. How will we finance our current liabilities? Well, it says they're 20,000. Okay, I can go, well, I've got 10,000 cash here, 5,000 accounts receivable. They only need another 5,000, so I need to sell $5,000 of inventory, for example. What if we can't sell this inventory though? Where will we get the cash from? Okay, well now I can go, oh, maybe I might need to dip into these. Maybe I need to sell this property or sell this vehicle, for example. And that answers our next decision. Should we sell some of our non-current assets? Will we have extra cash to pay off some of our loans early? It doesn't look like it, because look here, we've always got to factor this mortgage in. It's just going to sit there for years. So no, that not making a decision is still like a decision. We sort of, we got some information and then we acted in a certain way or didn't act. And should the owner maybe provide this business with a capital contribution? These are all decisions we can now make because we've got a classified balance sheet. And lastly, there's qualitative characteristic number 6 was understandability. Someone with a reasonable knowledge of business and economics should be able to comprehend the information by presenting it clearly and concisely and avoiding using jargon and complex terms. So, to summarize, there were 3 theories there: going concern, relevance, understandability. How does a classified balance sheet help us fulfill each of these? Well, let's look at going concern. Classified balance sheet assumes the business will exist into the future. Okay, and specifically, well, the classified balance sheet says we can assume that some assets and liabilities will either become cash or need to be settled within 12 months, and some will be non-current. So with the assets, for example, we can assume if we own a property, the business is going to be around in 20 years' time, just like the property will be, even though that might not be true, but that means we can classify that as a non-current asset, for example. Relevance said we need good decisions. So breaking assets and liabilities into current and non-current means we can make better decisions. We can see how much cash we reasonably expect to have in the next 12 months, the total debts to be repaid within 12 months, and whether there will be sufficient cash to pay them. So that's really important. Now that actually has a name. It's called liquidity. You don't need to know that yet. That's much later, but that is what that's called. Can you pay your debts within the next 12 months? Based on what cash you think you'll have in the next 12 months. Well, we can answer that or make that decision with a classified balance sheet. And lastly, I would argue breaking assets and liabilities into current and non-current makes a balance sheet more comprehensible to the user. They can see, I'm just going to write the same thing here. We wrote here for relevance. They can see how much cash it reasonably expects to have. We'll write that there and the same thing there. And we'll just say, yeah, that is called liquidity. Okay, someone can better comprehend liquidity when they can see what is current and non-current. Now remember, don't get confused if you don't know what liquidity is because you didn't do accounting in year 11 or haven't done it yet. That's okay, we'll come back to it later on. But that's basically what we're talking about here.